Let's talk about retirement plans. When you hear all those acronyms, 401ks, IRAs, 403bs, does your head kind of start to spin? It can feel super complicated. But what if I told you there's one simple way to understand pretty much all of them?
You've got the plans from your job, the ones you open on your own, and on the surface, they all seem totally different. But underneath it all, they actually share one fundamental thing that makes everything click into place.
That's it. Just two. Seriously. So for a second, just forget all the different names and the jargon. At its very core, every single retirement plan out there fits into one of these two buckets. And if you get this one distinction, you've unlocked the key to how they all work. And here they are: qualified plans and non-qualified plans. The entire difference, and I mean the entire difference, boils down to this. Qualified plans meet a special set of government rules, and as a reward, they get awesome tax breaks. Non-qualified plans don't. That's really the whole game.
Okay, so let's focus on that first group, because that's where most of us live. What does it actually mean for a plan to be qualified? What makes it so special that it gets this VIP treatment from the government?
Well, here's the official definition. A qualified plan is simply a retirement account that agrees to play by a specific set of federal rules. By following those rules, the plan qualifies for those really valuable tax advantages we're talking about. It's a deal, basically.
If you only remember one thing from this entire explainer, please let it be this phrase right here: favorable tax treatment. This is the whole reason these plans are so powerful for both you and your employer. It is the grand prize for following the rules.
All right, so why would a company go through all the hassle of setting up a plan that meets all these federal requirements? I mean, what's in it for them? Well, it turns out that favorable tax treatment isn't just for you. It works for them too.
So here's how that incentive works for your boss. When your company contributes to your retirement plan, they get to count every single dollar of that as a deductible business expense. It's just like paying for rent or office supplies. And what does that do? It directly lowers the company's taxable income, which means they save real money on their taxes.
Okay, now for the part that really matters to you. The business gets a tax break, sure, but what about the money they just dropped into your account? How does this whole favorable tax treatment thing help you build your own wealth?
This is the crucial question, right? Your employer just gave you money. That's income. And normally you have to pay taxes on your income. So when does the IRS get to take its cut from this contribution?
And here's the absolute magic of it all. You don't pay taxes on that money now, not this year. The tax bill gets pushed way, way into the future. You only pay taxes on it when you finally start taking the money out, which for most of us is going to be decades from now when we're retired.
Just look at how incredibly powerful this delay is. The contribution gets made now, no tax. Then, for your entire career, all the earnings, all the growth on that money, also not taxed. Year after year, it compounds without the drag of taxes slowing it down. It's only at the very end, when you're in retirement and you start making withdrawals, that the tax bill finally comes due.
So let's bring this all home. We've seen that the big core difference is all about when and how you pay taxes. Now let's nail down exactly why this simple distinction can have such a massive impact on your financial future.
It all boils down to this one powerful sentence. The earnings of a qualified plan are tax-deferred until they're withdrawn. Think about that for a second. It's not just the initial contribution that gets the tax break, it's the earnings. Every single dollar your investment makes gets to stay in the account and keep working for you year after year.
And this is the beautiful result. It's like your retirement savings are running a marathon. A qualified plan lets your money run free without any waits. Meanwhile, other investments have to stop every single year to pay a tax toll. That compounding growth, completely unburdened by taxes, is the absolute superpower of a qualified plan. And it means way more money for you in retirement.
So the next time you look at your retirement account, don't just see the balance. Ask the simple question, is this thing qualified? Because knowing the answer to that one question tells you if your money has that incredible superpower of tax deferral working for it. It is a simple distinction, but believe me, it makes a world of difference.